Okay, so if you look in Canvas, you can see this helpful handout for exam 1 for the exam. And so I pulled that up, and as you can see here, kind of small, make it a little bit bigger. It has all of the formulas that you'll need to know for the exam. And so you can calculate the cost of good manufactured, the cost of goods sold. And so it's important to read the question to really know what it's asking. It can ask you for any one of these items. And so just remember that the cost of good manufactured can be calculated by using these inputs, but it also can be calculated by using the finished goods and the ending finished goods and the cost of goods sold and working backwards up to the cost of good manufactured. And some of the questions on the exam, they'll ask you for the cost of good manufactured, and they'll give you the beginning and the ending, but they won't give you the cost of goods sold. They'll give you the sales and the gross margin. So you first would find the cost of goods sold and then plug it in backwards to get the cost of good manufactured. Merchandising company is similar, and you will need to know that as well. And like I said in the previous video, it's important to know the variable versus the fixed costs. And so, for example, if the activity was increasing, the total variable costs with an increasing amount of activity or increasing amount of units would go up the total variable cost. But as you increase the number of units or activity, the cost per unit would stay exactly the same. It's still going to cost you the same amount per unit. For fixed costs, if your activity is increasing, that won't affect your total fixed costs because it's fixed, no matter how many units you're making within the relevant range. But if you increase the activity, the number of units will be increasing, but the price per unit will be decreasing right here, as you see that. So you increase the number of units, and then your cost per unit will decrease with the fixed costs. So that's just continuing from chapter 1. And so I'll pull up our review sheet again. So as we see, this is the formulas in 1.4 and then the behavior of fixed and variable costs 1.5. Moving on to chapter 2, understand the purpose and elements of a job cost sheet. So direct materials, direct labor, and overhead. And overhead is based on a predetermined overhead rate. So you're really going to need to know how to calculate that predetermined overhead rate. And from the reading, it's all going to be an estimate. So the total estimated overhead costs divided by the total allocation base. And then, so that'll give you, for example, like $8 an hour or $5 per, your allocation base, which could be a machine hour. It could also be direct labor hours, things like that. And then once you get this predetermined overhead rate, you'll times it by the actual amount of hours incurred for the period, actual allocation base incurred. And so in problems, they'll give you the estimated overhead costs over the estimated allocation base, and then they'll give you the actual hours and the actual cost. So first you will find the predetermined overhead rate by using the estimated, times that by the actual hours, and then compare that to the actual total cost. And that's also in some of the PowerPoints, that sort of formula and how you apply this predetermined overhead rate. So I like to think of it as you start off, you don't know really hardly anything in the beginning, it's all estimates. You start working and you know actually how many hours you're using, but you don't know the actual cost. So you apply this estimate, times it by the actual hours, and then in the end you finally know the actual cost of everything that you've produced, and so then you compare your amount that you get from the actual times it by the predetermined overhead rate to the actual total cost, and then see if you're over applied or under applied. And so understand the flow of costs for a job order costing system. So a brief exercise 2-4, 2-6, and 2-15. And so I want to go over exercise 2-14, and I'll post the solutions. And so 2-14, it's journal entries and T accounts. And this is a great overview of Accounting 201, and it's going to be really relevant for the exam and highly tested on the exam. So just knowing how these journal entries flow through the accounts will be very beneficial to you. So I'm just going to go through an example right now. So I've just set up all these T accounts, and they should all be 0. And it gives you all the entries and says prepare journal entries and prepare T accounts. Post the relevant information, compute the ending balance for each account, and assume the work in process has a beginning balance of 42,000. So the work in process, so this is exercise 2-14, just so you know, and this is on page 112 in the textbook. And it says the beginning balance of work in process is $42,000. So that's going to be a debit balance of $42,000. So raw material, so I'm starting with A, raw materials purchased on account was $210,000. So in our journal entries, we'll say raw materials was purchased. That's a debit of $210,000. And we have a credit, and it said it was bought on account, so that would be an accounts payable. Accounts payable, 210. So debit over here, and a credit over here. Okay, we're going to go to B now. B says raw materials used in production 190,000, 178,000 was direct materials, and 12,000 was indirect materials. So now we're taking some of this, not all of it. We're going to credit it and take it out and use part of it in the work in process, but we only want to use our direct materials in work in process. And we know that indirect materials are still a product cost, but they're not direct, but they're still a product cost, so they'll go into manufacturing overhead. So that 12,000 of indirect materials will go to manufacturing overhead. So we'll say work in process, that's our direct materials. That will be a debit of 178,000. And indirect materials, or manufacturing overhead, indirect materials will be 12,000. And we will credit out the 190,000 from raw materials, because that's the amount that we're going to be using right now, and they'll be left over still in that raw materials T account. And then we'll debit the direct materials, 178,000, and debit the manufacturing overhead, 12,000. So as we see on this left side, it's the actual amounts that's happening from manufacturing overhead. So they actually issued these to production, and they actually incurred $12,000 of indirect materials. Okay, we're going to go on to C. Direct labor costs incurred 90,000. Indirect labor costs incurred 110,000. So again, indirect will be manufacturing overhead. So for C, we're going to have direct labor, which will go to work in process. Indirect labor will go to manufacturing overhead. And then we'll have a credit of, we're having this labor, so we need to pay our workers for the labor that they're doing. So this will be a wages payable. So we have a debit of, what does it say, 90,000 and 110,000 indirect. Wages payable will be 200,000, right? We total that up, it'll be 200,000. So we have a balanced journal entry. So direct labor, 90,000, manufacturing overhead or indirect labor, 110,000, and our wages payable, 200,000. Okay. So now, depreciation recorded on factory equipment. So we know that depreciation is not direct materials and it's not direct labor. Direct labor is normally the people that actually are assembling and putting together and working on the product, that actually touch the product, but it's still a product cost, so it'll go into our manufacturing overhead again. So that's depreciation expense. So our journal entry, depreciation and accumulated